Today, we're going to crack open the case files of a very special kind of investigator. These folks don't wear trench coats, but they are hunting for something incredibly elusive: the truth hidden inside a company's financial story. We're talking about auditors, the financial detectives.
I mean, think about it. Every year, massive companies publish these big, glossy reports telling us how much money they made, what they own, what they owe. But they're telling their own story, right? So how can we as investors or employees really know if they're telling the truth? Well, it turns out there's a whole system designed for exactly that.
And that system is called an audit. The simplest way to think about it is as the professional, totally independent investigation. An auditor's job is to sift through all the evidence, the contracts, the transactions, the internal computer systems, and deliver a verdict. Is the story the company is telling about its money true and fair?
To really get how this works, let's open up our first case file. This is a classic, a scheme that auditors are always on the lookout for, something that can happen right under a company's nose. Let's call it the case of the phantom employees.
So, picture this. You've got a payroll clerk, someone who's trusted with really sensitive info. They realize they can play this system. They invent a few fake employees, ghosts in the machine, and set up their salaries to be paid directly into a bank account that they control. It's a quiet crime buried in thousands of other, perfectly legitimate payments.
So how's the trick pulled off? First, these phantom employees get added to the official company payroll. Then, every single payday, their wages just automatically flow right into the clerk's personal account. And the only reason this works is because of a massive failure in the company's own defenses, its internal controls. Nobody's double-checking the list of new hires or really scrutinizing the payment logs.
And this scam could go on for years, just quietly siphoning off thousands, maybe even millions of dollars. The company has no idea. So the question is, how does an auditor, an outsider who only comes in once a year, manage to find these ghosts?
Now this is where it gets really clever. Auditors don't usually go in looking for the fraud itself. Instead, they test the system that's supposed to prevent it. They'll ask, did a real manager actually sign off on this new hire? They'll run the data to see if maybe 10 different employees are all being paid into the exact same bank account. They look for weird patterns, for weaknesses in the company's armor. It's by finding those cracks in the system that they usually stumble upon the crime.
Spotting fraud is one thing, but honestly, an auditor's most critical job is to stay unbiased. And that means walking a very, very fine ethical line. It's like walking a tightrope, all while under some serious pressure from the companies paying their bills.
And this right here is the absolute heart of the matter, the entire value of an audit. The only reason anyone trusts that final report is because the auditor is supposed to be objective, an impartial third party. The second that objectivity is gone, the whole system just collapses. This isn't just a theory. We saw it happen with giants like Enron, whose collapse took its own legendary audit firm down with it, all because that trust vanished.
This really lays out the two sides of the coin. On one side, you have the ideal auditor, skeptical, asks tough questions, and is totally independent. But on the other side, you have the real world. You have the constant pressures. What happens when the company you're auditing is paying your firm millions of dollars? Or what if your best friend from college is their chief financial officer?
And these threats are very real. A self-interest threat happens when one single client makes up a huge chunk of your firm's income. A familiarity threat, well, that's when a personal relationship gets a little too cozy, like if the lead auditor's daughter works for the client. Self-review is a huge no-no. You just can't objectively check your own homework. And yeah, intimidation can be as blunt as a client saying, "Give us the report we want or you're not getting paid."
So, with all these pressures pushing and pulling, what keeps the auditors on that tightrope? How does the whole profession protect its most precious asset, its objectivity?
Well, luckily, there are a bunch of safeguards built right into the system. For example, the lead auditor for a big company has to be switched out every few years, just to keep things fresh and avoid getting too comfortable. Other partners will come in and do independent reviews of the audit team's work. And there are super strict rules and disclosures designed to catch these conflicts before they ever become a real problem.
All right, let's open our next case file. This one isn't about some secret, outright fraud. It's about something way more subtle, but just as dangerous. Financial reports that might be technically correct, but are just not telling the true story of what's happening in the business.
Okay, so you're the auditor, and you're looking at these draft numbers. You see revenue is down, gross profit is down. Okay, makes sense. Maybe they had a tough year. But then, wait a minute. Inventory, the amount of unsold stuff they have sitting in the warehouse, is up a lot. Now, why on earth would a company that's selling less stuff be holding more of it? That's a red flag. This is where the real detective work kicks in. The numbers are telling a story that just doesn't add up. So, what's really going on behind the scenes? What reality are these numbers trying to paper over?
So the auditor starts digging, and it turns out, to cut costs, the company switched to a much cheaper supplier. The problem? The quality of their products took a nosedive, and customer returns went through the roof. That's why all that inventory is piling up. It's broken stuff nobody wants. And to hide the hit to their profits, management just decided their factory equipment would magically last 5 years longer, which let them report a smaller expense.
And here's the key. The auditor's job isn't just to check the math. It's to make sure that giant growing pile of broken inventory isn't being valued at full price. And it's to challenge that sneaky accounting change. The books, simply put, have to reflect reality, no matter how harsh it is.
And they do this with actual boots-on-the-ground procedures. They physically show up at the warehouse to look for dusty, damaged boxes. They check the sales records right after the year ends to see if that inventory had to be sold off for pennies on the dollar. And they sit down face-to-face with management and make them justify every single one of their accounting decisions.
So after all the systems have been tested, all the ethical tightropes have been walked, and all the numbers have been checked against the cold, hard reality, the investigation reaches its climax. It's time for the financial detective to deliver their judgment.
Now, this judgment isn't whispered in some back room. It's a formal, public document that gets stapled to the company's financial statements for the entire world to see. It is called the audit report.
And that report delivers one of 4 basic verdicts. The one everyone wants is an unqualified opinion. That's a clean bill of health. Then there's a qualified opinion, which is kind of like saying, hey, everything looks pretty good except for this one little thing over here. The worst case scenario is an adverse opinion. That's a huge red flag. Basically, the auditor's saying the numbers are flat out wrong and you can't trust them. And finally, there's a disclaimer, which is when the auditors just throw their hands up and say they couldn't get enough information to even form an opinion, which is also very, very bad news.
And it might just sound like a piece of paper, but this verdict, this is what allows our entire economy to function. It's what gives investors the confidence to put their money into a company, what allows banks to lend money, and what gives employees the confidence that their company is stable. It really is a cornerstone of trust.
But you see, it all comes down to the integrity and the skill of these financial detectives, which leaves us with one last really important question to think about. If auditors are the watchdogs that keep corporations honest, who's watching the watchdogs?